Hello, welcome to PSR People Speaking Rail. And Joanna, you got your laptop to work. I can see you fine.
No, this is actually my phone.
Oh, it's your phone.
I have to
Okay.
figure out how to work the laptop. So maybe sometime 3 weeks from now it'll be all good. Or we might just be using my phone. so,
Okay. I
but
was
yay,
wondering why it looked so good.
technology.
It's like that explains
Sorry.
it. That explains why you look so clear. I mean, the cameras on the phones these days. They put like a
Yeah,
$1,000
yeah.
camera on a phone. But good to see you in any event. And you've been doing the sort of thankless job of going through all the earnings reports, listening to all the conference calls, the many questions. At a high level, what are your takeaways so far?
Let's see. So far only as of Tuesday afternoon, only Union Pacific and CSX have reported earnings. But
Mhm.
interestingly, they were actually fairly. There were some fairly similar themes. I mean, one is um, the idea of uh, what is it now, like trying to get more input from those closer to the operations, whether not necessarily um, those kind of on the ground, but like kind of more closer to might have more of a sense of
Mhm.
how things are running, um,
Mhm.
and getting their input more. I mean, both UP and CSX kind of mentioned that as possibilities as a way to um, to to cut costs, but also just kind of reduce any potential red tape that might be happening in operations. So that's one thing. The other interesting thing between both calls is that you had two industry veterans separately being part of their calls for the first time. So you had
Mhm.
um, Jim Venna at UP, assuming in his new role as CEO, even though he's been with UP before, but and so there was still, I think, a sense of trying to among the investors anyway, like kind of trying to feel him out in terms of where he might stand on things, and that's kind of where he mentioned sort of the cutting the red tape. And then you also had uh, oh my gosh, I blanked out on his name. I feel bad, but the CSX Mike Corey, sorry, in
Mhm.
assuming the chief operating officer role, who and Mike had been at CN for quite some time, before leaving in 2019 and then doing something else, and then came back and replaced the Jeremy Boychuk, and so it was interesting that a lot of investor questions were kind of also kind of at kind of trying to get a sense of where he might stand on on operations and then cost cutting and then stuff like that. Um, it was kind of interesting as a side note, like the one of the investor questions. I'm totally paraphrasing this, but when one of the investor questions was like, so
Mhm.
thinking about your failures at CN, what would you like to do differently at CSX? And then Mike was responding, well, wait, nice to rub salt in the wound, kind of thing. But I mean, he
Mhm.
didn't say
Mhm.
that either. But it's just kind of I just thought that dialogue was kind of interesting. I'm paraphrasing both the investor and Mike, um, but it was just kind of interesting just to see, I guess the questions were kind of looking at like, if CN right now has positioned itself as a growth railroad post precision scheduled railroading.
Mhm.
CSX would like to be in that position if it's not in that position already. And so how does Mike Corey fit into this picture? So those are the two kind of um, uh, main impressions I got from comparing both calls.
Yeah, I thought there were a lot of similarities as well. You bring up all the point about the former CN alums. You also saw some similarities in terms of just financial statistics, like the
Mhm.
operating ratio went from sort of just under 60% on both of them to sort of, what was it, UP 63, 4, I think it was something similar at CSX. And so it almost seems like we're maybe starting to head into a period where there's going to be less focus on operating ratio. I think there was probably too much focus on operating ratio for however many the previous years, and now we're sort of in this period where there is more focus on service. There's more focus on just having the resources in place. There was one of the executives, was talking about how they were going to have sort of extra resources for when things do go wrong, whether that's a sort of a snowstorm in Chicago or just congestion a certain part of the network. So I thought that was interesting. Have a financial table on Union Pacific if we could get that up. So there's that, and kind of the one thing that stands out. Well, a few things stand out. I mean, one of those things is that the industrial economy is still pretty weak. If carloads are down, 2.7%, I guess that includes intermodal. But the consumer side of the business, which is intermodal, that's worse than the industrial side. So you see intermodal shipments down 5.9%. This is Union Pacific. They do a lot of international intermodal in addition to domestic intermodal. And that other one, that intermodal revenue per car down 12.7%. Now that does include fuel. It's still a lot of pricing pressure on intermodal, and you see kind of the results of that. EPS down 17%. It was down a similar percentage at CSX, and then you see that OR unfavorably increasing 580 basis points year over year. Well, maybe it's not quite that much, 350 basis points year over year. So all those things, I think it wasn't a surprise last week to the street because Union Pacific had already talked down some of these numbers. Another stat that's not on there, but I had in my notes, is that Union Pacific had 2.5% more employees on 3.9% fewer revenue ton miles. And so fewer, revenue ton miles is a good measure of how much work the railroad is actually, doing. So call it 4% fewer ton miles, 2.5% more employees. And we know that those employees are getting paid more after the negotiation last year. So you do have some inefficiencies there in terms of matching the costs with the revenue. But I did think that sort of across the board, the service metrics looked pretty good. Sort of service and productivity metrics in terms of how productive the companies are using their equipment. Union Pacific said freight car velocity up 5%, locomotive productivity up 4%. And then I would also agree with you. That comment from Jim Vena was interesting. That he said you can't have 9 levels between the CEO and the people actually doing the work on the front lines. It's just there's just too much of a disconnect in terms of what actually is causing some of those congestion points. What it could actually be improved in the operations on a day-to-day basis. And so they want to streamline that so the people who are ultimately managing the operations at a high level really understand what's happening, at the ground. That was interesting as well. And then there's another interesting quote from Union Pacific. It said the Kansas or Canadian Pacific, Kansas City Southern might have an advantage in the OD pairings because now they have such a broad reach. But Union Pacific's advantage is just really its network going through the 23 states, a lot of the states that are faster growing in terms of speaking about intermodal growth. So all things considered, there's a lot of these numbers are adverse versus they were a year ago, but I don't think there were any big shocks last week.
Mm-hmm. Yeah, I don't think so. And I think everyone's pretty much expecting, at least for rail. I don't think anyone's really expecting anything particularly explosive to happen. I mean, in terms of what I think everyone's pretty much this isn't the best quarter, but things get so yeah yeah.
Yeah, if we want to put up the CSX financial table, some of the similar things there that to call out. So they're similar decline in EPS. So theirs was down a little bit more, down 19%. This is CSX looking at the third quarter of 23 versus the previous year. But you do see some operating statistic improvements with train velocity up 11.4%, terminal dwell down 19%. They also called out, not in that table, but the intermodal trip plan compliance was 94% in the third quarter. That's up from 90% in a year ago. And that's something that I've heard anecdotally. Some of the people we've had on this show, usually ask about rail service, if that's something that pertains to them. Let's say if they're a shipper, and most of those shippers have said, the rail service has been pretty strong, and the ones that they call out as being is really making a lot of progress there. Has been CSX. Another interesting thing that CSX, coming out of their earnings, they said there was a big difference between the international intermodal side and the domestic intermodal side. So they're seeing domestic intermodal volume growth that's turned positive, but it's still sharply negative for international intermodal. And some of the reasons for that is the still sort of uncertain container demand, sort of some weakness in the imports. It hits the international side, more than the domestic side. They credit some of the growth in partnerships with the truckload-based intermodal companies as helping to grow that domestic intermodal volume. They believe Schneider is a big partner of their, in the East. But then they say, sort of countering that to some extent, is that there's still ample truck capacity. That remains a headwind. That's a big deal, specifically for the Eastern Class 1 railroads, because, really all of their lanes are competitive with the highway. You think of something like Chicago to Atlanta being, just about a one-day, trip on the highway. Sort of Chicago to the New York area being about a 2-day trip on the highway. So all those are very competitive, with the highway. So there's those pressures. And then, it's kind of an interesting quote from the chief commercial officer, Kevin Boone. He says, you have Western Class 1s going after the Mexico business. They can participate in that, and willing to work with them. They said there's a lot of momentum with working to create opportunities and in intermodal. And for decades, they've been pushing volume. The volume for decades, they said, has been going off of the railroad and onto truck. So they're going to work with some partners to reverse that trend. So CSX seems to be talking a good game on service levels, but there's also some statistics there that I think sort of back that up, that service levels have improved. Would you agree with that?
Yeah, I would think so. I mean, I think even, and it's not even just, that's noticed it. I think, Surface Transportation Board Chairman Marty Oberman had mentioned. I think, that, actually it's with the STB requirements to the four US based Class 1 railroads, asking, for them to submit on a regular basis service data. This is kind of based on what happened in the spring of 2022.
Mm-hmm.
And I think, CSX was, several months ago was the company that STB cited as, not having to fulfill all those data requirements any longer for that particular proceeding, because service has improved for them. So sort of my long way of saying that STB and Chairman Marty Oberman have noticed that CSX's service has improved.
Mm-hmm. Yeah, I would agree with that. The STB is now requiring those railroad, service metrics, which, I've been monitoring, specifically the intermodal delay days, and those have really gotten a lot better. So a lot fewer rail cars are being delayed. I want to turn to another company that benefits from rail service. That's J.B. Hunt. J.B. Hunt reported last week. That was one of the only ones I saw that surprised the market, that stock was down after reported. But so there were some positives in that report. So I'll call out a few of these here. They said there was a 1% increase in J.B. Hunt intermodal volume. They say they're taking share. As you imagine, Transcon doing better in volume than the Eastern one. That's just more insulated from the trucking competition. Their average length of haul is about 1,700 miles. So overall, their intermodal is pretty well insulated from the loose truckload market. That LA to Chicago corridor being far and away the densest for them on BNSF. But that 1% increase in JB Hunt volume, they say that represented taking a market share. And I would agree with that. Based on what we're seeing in Sonar, have a domestic rail container volume chart for the loaded volume. If we could get that up there, and it's going to be the previous one. So this one here. So this showed in the third quarter, if we're just looking at sort of July through the end of September, July 1st through September 30th, the volume on the domestic side, these are loaded 53-foot containers. So very much the industry that JB Hunt competes in, that was down about 1% year over year. JB Hunt saying they were +1 in taking some share. So would agree with that. And then the other thing that's interesting here is you look at October, and volumes have been pretty solid in October. Now, that may be as high as they go. October is traditionally the peak month for intermodal volume, but still it's up about 4% year over year in the first 23 days of October. So there is some volume surge there. Carriers like JB Hunt would say, well, there's still plenty of excess capacity. You remember earlier in the year, they talked about having 15 or 20% excess capacity. But that was something that they talked about on their earnings call, as well as being sort of a positive leading indicator. They talk about intermodal volume, being a little bit of being a leading indicator, and pricing as being a lagging indicator. And on the capacity side, one thing that was interesting is in their financial grid, they called out how that they have 117,387 pieces of average trailing equipment in the quarter, so primarily domestic containers. And the usage was 96,000. So that suggests 82% of their trailing equipment utilized. Year to date, it was only 80.5%. So, still a lot of latent capacity there going by counts of pieces of equipment. The year ago period, it was 96.5% utilized. So much more slack in the system in terms of available capacity in the domestic intermodal industry than there was a year ago. So I think that is important. And then want to highlight the next chart, intermodal contract rates, which this is domestic intermodal contracts. This excludes fuel surcharge. And I do see it kind of go up and down from week to week, and part of the reason for that is just mix of what's in that. There's not a consistent mix of transactions every week. But if you look at the third quarter overall, that white line from July 1st through September 30th, compare that to a year ago period, I have it down 17% year over year, whereas JB Hunt said theirs was down about 14% year over year. So pretty consistent. Always going to be changes in mix, versus what we see versus what they're actually moving, and some of the transactions that go into that chart are not being moved by JB Hunt; they're moved by Hub Group or Schneider or somebody else. But it really sort of highlights the intermodal pricing pressure versus a year ago, and I think that's might have been what surprised the street, and the associated margin compression, which is what most of the analysts asked about, was the outlook for margins. A lot of pricing pressure, like is just going to flow straight through to the margin, so that's not really a surprise. So that's a little bit of what's going on with JB Hunt and the intermodal industry. And I know you, Joanna, you're planning on writing up the equipment suppliers earnings reports and what they are reporting. Did you have a chance to listen to GATX earlier today?
Yeah, I did a little bit. I mean, I think trying to think. I mean, I think there's still. I mean, obviously, there's always going to be a bit of a spin on things, and so, I didn't really hear anything alarming in terms of where they view the market, and I think it's kind of in line with what they've said in past earnings calls in terms of
Mm-hmm,
demand,
mm-hmm.
and just kind of. It was an interesting question about inflation and how I don't know if it's necessarily newsworthy, but it's interesting for me, like in the sense of like sometimes like higher inflation can actually benefit lease rates because the higher inflation might add too much cost for a new rail car, but it might make leasing a more attractive option. So I thought that was interesting. And so yeah, but yeah, GATX was Tuesday morning, and then WabTech, which is slightly different, but still within the same broader space, is Wednesday morning, and Greenbrier Companies is also Wednesday morning. And so yeah, I'll try to write them all up, and then Trinity Industries is actually not for another week and a half. So
Mhm,
and then
mhm.
Freight Car America is like they usually report like further down the road. So so yeah, we're still kind of in the thick of earnings season, at least for both rail equipment manufacturers and the Class One railroads.
Yeah, it seemed like there wasn't anything too surprising in GATX. I mean, it seemed pretty consistent with what we heard previous, quarters. So there really hasn't been any loosening in that market, even though rail traffic has been a little bit weak. So many of the rail cars are just very specific to what is being hauled. So you can have
Mhm.
looseness in some areas, tightness in other areas, and GATX always does a nice job of rebalancing its portfolio of rail cars to not get caught with too many that are have a weakening demand. I saw that CEO Bob Lyons said it was consistent with his initial outlook. In the quarter, they have this lease price index, which everyone watches very closely, and that was up 33.4%. And so what they do is they compare the rates on new leases with rates on expiring leases, and so it's 33% higher on the new leases, and then they have an average renewal of 65 months, so call it 5 years and 5 months, and they're continuing to lengthen the lease terms on many of those car types. And so what that tells you is that they think that the lease rates are currently higher than what would be sort of the long run equilibrium point. And so the idea is to extend out those lease terms for longest period possible to sort of lock in those lease payments and cash flows. They also said the fleet utilization was 99.3 at the end of the quarter, and the renewal success rate was 83.6%. So most the shippers renewing their leases, and still seems like the fundamentals in that in that industry, still pretty solid.
Mhm.
You also wrote up an article recently about is combining data streams help combat illicit trade in the container shipping. What can you tell us about that? I thought that was an interesting one.
Oh yeah. That was interesting. So it was kind of looking. I think their main purpose. It was Deloitte and Nexio or Nexia. I'm not, if I'm mispronouncing it. I apologize. But it was looking at the know your client service that Deloitte has, and how can you expand that offering, combining it with Nexio to address illicit trade that happens for containers mainly, and particularly at the ports, even though so it's just kind of using that existing sort of supply chain data, kind of looking to see the end-to-end shipments, and and just kind of seeing where containers are, but sort of matching that also with financials associated with those containers. So it might be like insurance associated with the goods, or with the container, and also and also um, the devices on the container that sort of track whether it's been opened or not. And so, but again,
Mhm,
the whole
mhm,
broader idea is to sort of address the illicit trade that happens. And you think about all those the cross border shipments, and all, and sounds kind of the obvious point of the week. I mean, there's just so much stuff that moves, and lots of things that moves, and you could have
mhm, mhm,
so much data. And so how, what can you use to ensure that what is in the container is actually in the container, and not some contraband, or some crazy thing like
mhm, mhm.
fireworks or something. Yeah, so So it was interesting to write about.
Yeah, and it seems more important now than ever with all the geopolitical uncertainty. You know, want to make sure no
Mhm.
one is illegally selling arms to Iran or somebody. And then the other thing that's interesting is, I hear a lot from customers on the data side that there's a lack of visibility. Once the container ship hits the docking point, where they know exactly like kind of where what ship their container is on, and they know they can track that container ship. But then there's kind of a black box once the ship pulls into the harbor as to how long that container is going to sit on the rail yard, and they don't know whether that's going to be 1 day or 6 days. So that's something that hopefully they can address too. So encourage people to read that article. Next week we're going to have Dan Walsh, CEO of Track Intermodal, on the show. So we'll really dig into the chassis leasing market and see whether there could be another chassis leasing shortage. What his expectations are for the market, all of those things. So I encourage everyone to tune in next week. And with that, I hope everyone has a great day.